Have you ever felt like the world looks calm, but something deep inside tells you it isn't? That uneasy silence right before the storm hits. When everything looks normal, yet the air feels heavier, the light feels off, and you just know something's coming. That's exactly where America stands right now. Everything looks fine. The economy seems stable, the markets are breaking records, but underneath something big has shifted. Quietly, slowly, and almost no one is ready for what's next. So stay till the end, because what just happened might change the direction of the economy and the future of your money. Leave a like and let's begin. On paper, the story sounds perfect. The stock market is hitting new highs. Investors are celebrating, and headlines are filled with optimism. The economy is resilient, they say. But if you listen carefully, past the cheering, you'll hear something else. A whisper of numbers that don't fit the story. History has told this tale before, and every time it sounded this good, the ending wasn't. Let's start with something small. Something most people ignore: the unemployment rate. It sounds dull, it sounds technical, but it has always been one of the most accurate warning signs before a crisis. In 2007, it ticked up by just 0.5%. No one paid attention. Within a year, the entire financial world collapsed. In 2000, the same thing, a small rise right before the 2001 recession hit. Now it's happening again. Over the last year and a half, the unemployment rate has climbed by 0.5%. Seems minor, almost meaningless. But if you study 60 years of data, you'll see the same story repeating. A 0.5% rise has almost always signaled the start of economic trouble. And yet, what's the market doing? Setting new records. Investors are partying like it's 2007 again, ignoring the cracks beneath their feet. That year, the market also hit an all-time high just as unemployment began to rise. A few months later, it all came crashing down. The same signs are flashing again, but this time there's a twist. People don't want to see them. The Federal Reserve has kept interest rates at their highest level since 2008. That means borrowing is expensive for everyone. Families, businesses, even the government. Credit is tightening, growth is slowing, and yet the illusion of prosperity continues because the surface still looks shiny. But if you dig into the data, you'll find a very different story. For 3 years straight, the index of leading economic indicators, a trusted signal for recessions, has been falling month after month. The last 2 times this happened were right before the 2001 and 2008 recessions. It's not speculation. It's a pattern. A storm that forms quietly before it breaks. Job growth has nearly stalled too. Government data shows that hiring is slowing fast. The labor engine that once powered the recovery is losing strength. If job creation turns negative, that's when the real contraction begins. Confidence fades quickly when paychecks stop growing. All these small warnings have been building quietly. But what just happened recently could be the final spark. A global shock disguised as economic policy. Tariffs. At first, tariffs sound harmless, a way to protect local industries, tax imports, or balance trade. But in reality, tariffs act like invisible waves that ripple through the entire system. They raise costs, slow trade, and turn stability into hesitation. And hesitation spreads faster than any virus. Over the last few months, new tariffs have been imposed, adjusted, and threatened. The result? Businesses are uncertain again. Supply chains that barely recovered from the pandemic are once more tangled. Prices are rising, deals are delayed, and hiring freezes are spreading. And by the way, a quick break. I've opened a free Telegram community where I teach how to build and grow YouTube channels like this one. If you want to learn how to earn from content, the link is in the description. Now back to the story. If you study history, you'll notice a pattern. External shocks, whether oil spikes or trade wars, have a habit of pushing economies off balance. The 1970s oil crisis, the 1980s recession, the 1990 downturn, all triggered by sudden surges in costs. Even the 2001 tech crash and the 2008 housing collapse were preceded by energy shocks that strained the system. Every time costs rise too fast, growth slows and recessions follow. Oil has always been the heartbeat of global growth. When its price spikes, everything becomes harder: transportation, manufacturing, food, even electricity. Over the past 70 years, almost every major U.S. recession was preceded by an oil price surge of around 150%. That's like a massive hidden tax on the economy. Tariffs may not seem as dramatic, but they have a similar effect. They raise costs, limit supply, and create fear. Research shows that a 100% oil price increase cuts GDP by roughly 5%. Broad tariffs, according to studies by Yale and the World Bank, can reduce GDP by 2.5 to 3%. It sounds smaller, but here's the key difference: oil shocks are predictable. Tariffs aren't. They create uncertainty. Companies don't know what tomorrow's trade rules will be, so they freeze. Earlier this year, after the latest wave of tariff announcements, the S&P 500 dropped nearly 20% in weeks. It wasn't because companies suddenly lost money. It was because fear spread faster than facts. Markets froze, and panic nearly took over. That panic faded, but the danger didn't. What we're seeing now is not recovery, it's complacency. Corporate profits are high, balance sheets look stable, and people assume the worst is behind us. But history says otherwise. Before the dot-com crash, profits were record high. Before 2008, companies were celebrating growth. Then margins shrank, layoffs began, and everything reversed almost overnight. If you look carefully, profit margins today are flattening again. In industries like manufacturing, retail, and transport, they're already falling. That's usually the first quiet step toward layoffs. And layoffs spread faster than any virus. The U.S. economy is more fragile than it looks. Savings are shrinking, debt is massive, and inflation has eaten away at real income. The average household has less financial cushion than at any point in the past decade. Businesses are stretched thin, governments are drowning in debt, and the Federal Reserve is trapped between high inflation and slow growth, with very few tools left to fix either. That's what makes this moment different. Everyone believes the storm has passed, but in truth, the pressure beneath the surface has never been greater. The stock market's rise isn't proof of strength, it's a distraction. Because when you zoom out and look at 100 years of data, you'll see the same pattern over and over. 1929, 2000, 2007. Every time confidence peaked, a crash followed. The triggers changed, but the psychology never did. The moment everyone believes this time is different is the moment the cycle repeats. And that's exactly where we are again. Rising tariffs, slowing jobs, weakening indicators, they might look small individually, but together they form a familiar warning sign. The system is stretched, and one shock, one unexpected event, could push it over the edge. The next collapse won't happen overnight. It will start quietly. A few bad earnings reports, a rise in layoffs, a small market correction, and then suddenly everything will accelerate. That's how it always happens. The warning signs look boring until it's too late to react. I'm not a financial advisor. This video is for educational purposes only. Your financial decisions are your responsibility, and your results depend on your own actions. Stay smart, stay alert, and remember, the storm never announces itself before it hits.